Hey everyone, in today's video, I'm going to explain what debt is. For those who don't know, before starting my career in private equity, I worked in leverage finance in which I would help companies raise and syndicate debt. So to help share some of that knowledge, in today's video, I'm going to first give an overview of what debt is. Then I'm going to walk through a few common reasons a company would raise debt. And finally, I'm going to outline a few different types of debt. So to start off, debt is cash a company borrows from another institution that it agrees to pay back with interest at some point in the future. So to help better understand that definition, let's take a look at the sample debt agreement below. For every debt instrument, a borrower will be outlined, who is the company that receives cash today and has an obligation to pay back that money in the future. There will be a lender, who is the institution that loans the company cash today in hopes of getting paid back in the future. And the debt agreement will also outline the amount of cash that is loaned to the company today, the tenure or length of the debt agreement, as well as the interest rate, which has to be paid each year. So for the types of lenders, there are two main categories. First, there are banks that include banks such as JP Morgan and Bank of America. And then there's also institutional funds such as investment managers, insurance companies, as well as hedge funds who will loan companies money. Now that we know what debt is, let's look at a few common reasons a company might raise debt. First is for general corporate purposes. A company may raise debt to pay for general charges and expenses that arise in their everyday operations, such as paying for working capital or purchasing new equipment. Second is for acquisitions. A company will commonly raise debt to fund a portion of an acquisition. For example, a $100 acquisition may be funded by $50 of equity and $50 of debt. And a third reason a company might raise debt is to refinance existing debt. Many companies do not pay down their existing debt with cash flow from the company. Instead, they will raise new debt to refinance their existing debt. Now let's take a look at a few different types of debt. In this video, we're going to go over the three most common, and those include the revolver, the term loan, and a bond. And for each type of debt, I'm going to give a description as well as talk about a few unique characteristics so we can compare and contrast each type. So to start off, a revolver is an unfunded line of credit that a company can draw on up to a specific limit. This is very similar to a personal credit card, but it's for a company. A term loan is a funded loan from a financial institution that is required to be paid back over a specified period. This is very similar to a mortgage that you might have out on your apartment or house. A bond is a financial instrument purchased by an investment fund from a company that provides the company with cash today, as well as an obligation to pay the investment fund a specified amount in the future. Now looking at the type of lender / investor for each debt product, the revolver is issued by a bank. The term loan can be issued by a bank or an investment fund, while a bond is only purchased by an investment fund. For the tenure or length, the revolver is 5 years, the term loan can be 5 to 7 years, and a bond can range anywhere from 5 to 30 years. For the type of interest rate, a revolver and term loan are based on a floating interest rate, meaning they're based on an index such as LIBOR plus a fixed amount of basis points. For a bond, this is just a fixed interest rate, meaning that the same amount of interest expense will be paid each year. Now looking at the ability to prepay, for both a revolver and a term loan, a portion of the debt can be prepaid before the maturity date, while for a bond, no portion of the debt can be paid before the maturity date and everything is due at the maturity date. So that is a brief overview of the three main types of debt. Now, after watching this video, hopefully you have a better understanding of what debt is, why a company might want to raise debt, as well as better understand a few of the common types of debt out there. Now, if you found this video helpful, please like and subscribe below, and I look forward to talking to you guys again soon.